Hello. Start. Good morning, everyone. I hope you are able to see the presentation. Okay. So I think today's webinar is about decoding the interest rate cycle. We thought it would be an interesting point in time to actually have this conversation because uh, previously we've talked about how global monetary policy is actually diverging in 2024. So COVID brought all central banks together in terms of everyone following the same kind of monetary policy, even if it was not to the same extent. So all central banks felt that there was a need to cut interest rates, provide stimulus to the economy. There was a lot of uncertainty around how COVID would play out and what that actually meant for investors and savers, right? But as we put COVID behind us, there was a new problem that central banks were facing, which was on the inflation front. So then you had this period of tightening. It happened at different paces. So if we looked at India, we've not actually raised interest rates in a while. Whereas if we looked at the US, they continued to raise even when India was not raising interest rates. Whereas the ECB, Canada, etc., started cutting interest rates even before the US did. And now the Federal Reserve has actually given you a rate path which looks like for the next year and a half or longer, you're only going to see interest rate cuts. At the same time, there's a lot of divergence in terms of how people are thinking about whether the worst of inflation is behind us or if you're going to continue to have inflation surprises in the future, how unemployment is going to pan out, whether there's going to be a recession. So all of these things are still up in the air. And because that is something that's going on, we thought it makes sense to look at what's happening on the interest rate cycle and how that's going to affect investors and basically how you can plan your investments as well as prepare yourself for this new order of things to come. So this is the background behind why we are doing this webinar. I would also sort of just give you certain like housekeeping things that we do for every webinar, which is we would encourage you to also participate. This is a conversation. So any questions that you have, please type them out in the chat box. I try to keep the presentations short so that we can actually have a more meaningful and engaging conversation. And we'll get to the Q&A towards the end of the meeting. If there's anything else that you want to discuss, we'll be happy to do that. This is a webinar by Finance as well as M2W. So for those of you who don't know, M2W is or Milestones2Wealth is a program that we're running for investors. The basic idea being that we'd like to get you from wherever you are to your first crore in savings, and in a manner that is comfortable for you, with a lot of handholding, a lot of education that happens, because a lot of us don't actually get financial literacy, right? Whether it's from a formal curriculum as students or even later on in life, it's just things that we pick up on the way. So that's a little bit about us and why we're doing this webinar today. And without further ado, let me actually get started on the presentation. So part one is the wheel keeps turning. So the basic idea here is that the economy keeps going through different phases, and these phases form a cycle. So if you're at a point where the economy is expanding, then you're going to go into a flattish zone, and then you're going to come into an area where you're contracting, and then you'll come back to the expansion. So if we take a look at what that wheel looks like, you start with economic activity. And when there's a lot of economic activity, that results in growth. And when you have growth, you see that as how people will consume more and take on more leverage. So, for example, we know what happens when we get a bonus or a raise, right? When we experience a little bit of growth, what we tend to do is we tend to spend that money somewhere. Or when we feel a little bit more confident of our finances, we may settle down on buying a house. So that is your leverage, meaning you're borrowing to spend. And so that typically happens during the growth phase, when there's confidence about what the future would look like, or if the present resources are actually allowing us to do more. Then when there's leverage, you actually see a little bit of slowdown in the future. So it's an immediate spurt of activity followed by a slowdown. And then from that slowdown, what happens is you have a central bank or a government intervene, and they give you some kind of stimulus to ensure that your growth comes back through economic activity. Now, there's a very interesting 30-minute video that if someone is more keen on understanding this cycle of economic activity and the structure of expansions and contractions, there's a very nice video by Ray Dalio, and it's about half an hour long, but it explains a lot of cycles very clearly, like the interest rate cycle, the debt cycle, and the long-term debt cycle. So it's a great introduction to economics, and I would recommend that if you have half an hour to spare, that you definitely watch that video. So now we have to come back to something more simpler, which is what is actually driving growth, right? So you have liquidity, which pushes growth upwards because it allows people to consume and spend more. And then you have interest rates, which can either, when interest rates are higher, it discourages leverage and borrowing. And when interest rates are lower, it actually encourages more borrowing and spending. So that results in growth. Now, both of these factors are actually very important. Most of us tend to look at only interest rates because they're very visible and easy to measure. But liquidity is something that we need to track, because liquidity tells us whether, so you might have seen articles in the newspaper telling you that liquidity is in deficit or liquidity is in surplus. And all of this gives us an indication of whether we are heading into a higher growth trajectory or into a lower growth trajectory. So now we look at tracking interest rate cycles. So what actually happens in these cycles? How does it work? And that's what we'll sort of explore in more detail. So to track the cycle, we need to understand 3 or 4 key policy rates, right? And we need to see whether it's affecting the liquidity in the economy or if it's affecting the interest rates in the economy. So the first 2 sort of key rates that we want to look at are the repo rate and the reverse repo rate. Now, to put it quite simply, the repo rate is the rate at which banks borrow from, say, the RBI in India or any central bank if you're looking at a different economy. Now, it's usually the rate that you use for overnight financing, which means if you're having a loan for 1 day or 2 days, and this is required in the banking system because you have a lot of day-to-day settlements that occur. So now if your overnight rate kind of sets the, in some broad context, the benchmark rate for the overall economy, because if banks are borrowing at a certain rate, then they're going to lend, that is, if they're borrowing from the central bank, which is the safest borrower at X, then they're going to lend to peers at a little higher rate. And then their cost of funds will also be influenced by this. Then, so that sets the deposit rate, and then that sets the rate at which they're going to issue loans, depending on the type of loan. So it kind of trickles down into the economy at different levels, right? When you look at the reverse repo rate, that is the rate at which the RBI borrows from banks, and it's always going to be lower than the repo rate, right? So this actually influences liquidity and funding in the economy. So if the reverse repo rate and the repo rate are very close to each other, then banks are going to want to have a sort of risk-free or a close to risk-less transaction with the central bank. So their cost of funding may not actually matter. If they're worried about the quality of loans in the economy, they would prefer to take a little bit of a loss with the RBI. At the same time, if there's a wide gap between your reverse repo and your repo, then obviously you would see more traction and more lending that happens in the economy. So if we look at where we are today, we do have a wider gap, and we have maintained that gap has basically widened as your interest rates have been increased. Then we get to something known as SLR, or the statutory liquidity ratio. This is basically a requirement that the RBI sets for all of the scheduled commercial banks. And the idea behind this is that they want banks to maintain some portion of their assets in liquid securities, typically only government securities, right? And this again, so if the SLR is higher, that means the funds that are available for the bank to lend or create loans in the economy kind of reduces. So this is how it influences liquidity as well as funding in the economy. So if they have less money to lend, then the cost of that is expensive, right? And then similar to the SLR, you have another reserve ratio, which is the cash reserve ratio. And this is basically the amount of cash that the bank has to retain. So for all of their assets, some portion of that has to be maintained in cash and some portion of that has to be maintained in government securities. So again, pretty similar logic. If you have higher levels of cash reserve ratio, then of course your CRR, then of course the cost of funding for the rest of the economy actually goes up because there's less money to lend. So very simple dynamics, but very important to understand what the physics or the mechanics behind these interest rates are. So I thought we'd also quickly take a look at the history of the repo rate. So if we kind of see where this is heading and how the repo rate has been over the last few years, you would notice that basically if we go back 10 years in time and we look at data from 2015, we were in a falling interest rate cycle until about 2017. And if we correlate this with what happened in bond markets and stock markets, you would know that 2017 was basically like a bull run. So you had a period of declining interest rates that improved profitability and a lot of other metrics for firms. And then through that expansion phase, you had that positivity trickle into your financial markets, through the stock market. Then you had a couple of really good years. And then then you had interest rates rise up through 2018, 19. And at that point, you had a slowdown in the economy. This was also roughly the time when RBI's inflation targeting regime was introduced, right? So until then, we didn't have a mandate to manage inflation in the economy. Our mandate was primarily to look at interest rates. There was no fixed inflation target. Whereas today, the structure that we're operating in is that we want inflation to be at 4%, and there's a tolerance for that inflation to vary between 2 to 6%. So once you had this inflation targeting mandate introduced, so you saw the central bank sort of raise interest rates to bring inflation to that target level on the medium term. When that happened, again, your economy started to slow down, and you reached a point in 2019 where the central bank started to reduce interest rates. Now, we were still in a very difficult economic situation at that point. But what happened for us was that COVID occurred in 2020. So then you had a bunch of steep rate cuts because, again, at that point in time, you were worried about how the economy would cope. There was a lot of restriction on economic activity because of social distancing and all of these other things that came with the pandemic. And then you had a period of roughly, say, 1.5 to 2 years where you were at very low interest rates, right? And post that, you saw a lot of financial market activity, really more than economic activity. And then you entered a phase where you had very high inflation globally, and global central banks started increasing rates in 2022, starting with the Fed, and RBI followed suit. So we had 1 year of interest rate hikes. The Fed had almost 2 years of interest rate hikes. And then we sort of reached a point where inflation came more under control, and our interest rates have basically been stable for about 1.5 years now. And now we're heading into the next part of the interest rate cycle, where you're already seeing global central banks cut back on their interest rates, cut back on their growth forecasts, and sort of be a little wary of the amount of liquidity that's there in the economy. So this is where we are positioned contextually. We have a very crucial RBI meeting that's coming up this week. And of course, our team will decode that for you as well. So you can join us on Twitter Spaces if that's something that you want to know more about, or you can follow our YouTube channels and you'll see the updates there as well. So the big question is, will they cut rates? Will they not cut rates? What is the position? Are they going to follow the Fed? There are a lot of factors to consider, and there is no clear direction. From what the RBI has told in the past, it doesn't seem like they're looking at following the Fed. But at the same time, the global growth outlook is something that they have cautioned about in almost every meeting. And this week alone, you've seen a lot of geopolitical tensions flare up. There's been a lot of sort of radical updates on the Israel-Hamas war, and that is trickling down into global sentiment. So there's been a very risk-off sentiment for FIIs, and you've seen them pull out money from Indian markets. You've seen precious metals hit new highs. So all of this is happening, right? So this is the history of our repo rate, but it also tells a story about what is going on in the world and what is going on in the economy, because you can clearly see how growth, inflation, and interest rates are correlated in this story. So let me move on to the next slide, which is part 3. And this is about aligning strategies to what is happening in the macroeconomic context. So if we look at how fixed income actually delivers returns, there are basically 3 sources in which you can earn returns. One is, of course, the thing that all of us are very familiar with, which is the interest component, right? So if you have a fixed deposit, you get a fixed interest on your deposit, and that's a very predictable source of income. The same thing happens if you own a bond, because you get a predictable interest payout. And this is all assuming, of course, that there are no defaults, etc. Right? So then the next source of return is something known as mark-to-market gains, or MTM gains. And when we look at MTM gains, what is happening here is, as your interest rates move up and down, your bond prices will also change. The basic idea being that when interest rates go up, the yield or the expected return from your investments go up. And because interest is something that's fixed, the only thing that has to adjust to give you a better return is the price. So now the price has to go down for you to make the higher return. It can't go up for you to make the higher return. So that's why if you read any fixed income articles, or if you're looking at anything, you basically look at how the interest rates and the bonds prices actually move in opposite directions. So your mark-to-market gains can come from the change in the interest rates. Your mark-to-market gains can also come from the credit component. That is, let's say you lend to somebody who has low credit worthiness, but they use that money very wisely and they actually get better at managing their money, then their credit rating will improve over time. And when that happens, their cost of borrowing will come down. So when the cost of borrowing comes down, it will trigger again a mark-to-market gain on those bonds. So the basic idea being these two are primary sources of return, but there is a third source of return which investors have actually been chasing a lot in this market, which is what I like to call risk reward, right? What is happening in risk reward? In risk reward, the thing that you're looking at is you have the same issuer, but you're getting a different kind of bond, right? So, for example, let's take a very simple example that a lot of investors may be aware of, which is that banks issue regular bonds and then they issue something known as perpetual bonds. Now, the borrower at the end of the day is the same company, right? But basically, a perpetual bond carries a higher level of risk because, for example, there is no obligation for the bank to pay the principal back, right? It only comes with something known as a call option, right? Which is a feature of that bond, which means at the end of 10 years, the bank can say, I will recall the bond and pay you back the principal. But it doesn't have any obligation to do that in 10 years. It's just something that's there as an option. Then you can have the same company can issue something known as a secured bond and an unsecured bond. Now, the unsecured bond will obviously be riskier, so then it will come at a higher interest rate. Then you can have the same company that borrows for 1 year and 5 years. Now, the longer duration bond would ideally come at a higher interest rate. So these are all different ways in which you can play with returns and fixed income. And it's important for investors to know that this is what is happening. So if you see the same company borrowing at two different costs, the higher one isn't better for you. You actually have to understand what is going on there. Why are you getting a higher return on the same bond or the same company? So I thought we can just take a quick look at this very handy table, which shows us what our investment options are and how they work for us, right? So first is the simple, plain bank fixed deposit. So you earn interest. There is no scope for you to get mark-to-market returns. There is very limited credit risk, honestly. If you're going with a high-rated corporate FD or a bank FD, there is very minimal credit risk involved. And there's no liquidity in the sense that you can't take your money out from an FD whenever you want. If you do break an FD, you pay some kind of penalty. So maybe you will lose all of the interest or some part of the interest on that deposit. So that liquidity comes at a cost, which is why I've marked it as no liquidity. Then you get to corporate FDs. So very similar, except the credit risk is slightly higher when as compared to like a bank FD. Banks are basically governed by the RBI, and there's a lot of provision that goes in. And defaulting on a fixed deposit is actually a very, very high risk event, and we've not seen that happen. So even when you had Yes Bank or Lakshmi Vilas Bank, in all of these cases, FD investors got their money. There was just a temporary delay in sort of servicing those fixed deposits, but they were all honored at the same interest rate. Then you get to bonds where there is an interest component. There is also potential for a mark-to-market component. Usually there is credit risk involved in bonds. So it's important to evaluate them before you invest in them. And there isn't much liquidity available in the bond market. This is something a lot of investors don't fully understand because they expect bonds to be breakable or liquid, breakable like fixed deposits or liquid like debt mutual funds, but it really doesn't work that way. The bond market is getting deeper with time, so probably we will see it become more and more liquid, but as of today, it is not a very liquid space. So the best way for an investor to enter the bond market is to come with a hold to maturity kind of mindset. So whatever bond you're buying, it's best to assume that you're going to hold it until it matures. Then we move on to debt mutual funds. So within the debt mutual fund space, you don't get an interest or a regular income component in this. So this is where the big shift is, right? In the other instruments that we've seen so far, there's definitely like a fixed return component. In debt mutual funds, there is no fixed return component, which means that the primary source of return is from mark to market, right? and NAV appreciation through whatever income the portfolio earns. But that's not fixed because you can keep trading and the underlying portfolio can actually change quite frequently. And then you have credit risk. Now, with SEBI guidelines as well as categorization of mutual fund schemes, the credit risk is also limited because most debt mutual funds participate in the triple, like sovereign, AAA, and AA space, right? And the credit risk in AA is not too much, but at the same time, it definitely exists. And then with respect to liquidity, it's very liquid. So when you're looking at, and then last, let's just cover alternate investment funds. So with the AIFs, you don't have really an interest component. Depending on the fund, you might have a cash flow structure or you may not have a cash flow structure. You have the scope for mark-to-market returns. There is credit risk. They are operating in a lower rated space and there's no liquidity. So the important thing for an investor in fixed income to understand is you have to make certain choices. Do you want to take on risk? Do you want to optimize returns? Or do you want to manage liquidity? For somebody where liquidity is a priority, it's a no-brainer that the correct option for you is a debt fund. For somebody where returns are important, you can choose between AIFs and bonds, right? For someone who's looking at more predictable and safe investments, then probably bank deposits or corporate deposits are the best option. Now, given all of this, it's up to each investor to decide what their priority is and focus on that when it comes to product selection. So when you're talking to your advisor also, this is a great way to sort of tell them what you want, because then it makes that product investor pick much better. So let's talk about strategic investing, right? So when we're looking at strategic investing, we have to consider things outside of all of this taxation and return expectations. You need to first look at what is your goal, right? So is your goal short term? Is your goal medium term? Is it long term? Is it something that you're flexible about? Or is it a very hard set commitment that you can't miss? Then you need to look at your own risk profile. How much risk are you willing to take? Already taken in your other investments. So does it make sense to play this a little bit more conservatively, or does it make sense to play this a little bit more aggressively? So once you get a sense of your risk profile, it makes a lot of decisions much easier because you're able to assess and see where you can take on risk and where you shouldn't take on risk. So for example, when we work with investors who have only equity in their portfolio, the fixed income component is likely to be very, very low risk, right? Whereas if you're working with investors who want to take risk in fixed income but don't want to take risk in equities, then those portfolios tend to have riskier fixed income assets and low risk equity assets, right? So it's completely up to each investor to decide what their risk profile is, what they want to achieve with this, what are the timelines that they're working. Now, this is more specific to you, and this is where the customization actually happens. But where the customization is less is on the macro side. So we've talked about the cycle. You need to know where you are in the cycle. So when you're at the bottom of the interest rate cycle, you don't want to take on longer duration assets. You want to take on more short-term assets that you can refinance at higher rates as rates keep increasing. When you're at the top of the interest rate cycle, again, this time is a very different situation because globally you're dealing with a lot of excess stimulus. You're also dealing with flatter yield curves. There's a risk of recession. So all of these things actually don't spell like a duration call immediately. But ideally, in a normal cycle, when you're at the top of the interest rate cycle, you would like to take on more duration. And then you also need to look at growth prospects, inflation, these other macro factors that are going to influence the kind of products that you choose. Then you get to the behavior aspect, right? So if we look at today's market, investors have really flocked into equities. with a very linear expectation of how that asset class would work. Meaning they are looking at compounding as a every year kind of return. So they want to see 15, 20, 25% year on year. Whereas that's not how the market works. You will have some years where you're earning high returns. You will have some years where you're not really earning any returns. And then you will have some years where you're earning negative returns. So this is how the equity market works. And accordingly, investors need to prepare to participate. So on the years where you're earning much more than what your average expectation should be, you need to actually book out profits and restructure your portfolio. On the years where you're earning much lesser, even when returns are negative, that's when you need to scale up participation. So this cyclical nature of investment works better when you follow a more multi-asset approach. So having both fixed income and equity will allow you to play this market cycle much more smoothly. And reviewing how other people are going to behave when things go in an unexpected direction is very important in assessing your own strategy as to how you want to participate in markets. So lastly, let's come to the role of fixed income. So like I was saying, you want better behavioral outcomes. How does that really work out? So this is basically Nifty rolling returns from December 1999. And if we look at what is the percentage of times that the returns have been negative, right? So 1 year returns have been negative almost 1/5 of the time. 2-year returns have been negative 16% of the time, right? 3-year returns have been negative 5% of the time. And 4-year returns have been negative about 1.5% of the time. And 5-year returns have also been negative, but at a very small 0.1% of the time. So this means that when people tell you that have a long-term approach to equity investing, what they're trying to tell you is that, yeah, there's a good chance that your 1-year returns will be bad. 1 out of 5 years, you're going to, 1 out of 5 times, depending on where you start in investing, you are going to earn a negative return, right? Almost 1 out of 9 times, you're going to have a negative return if your investment horizon is 2 years. So this is why it doesn't make sense to take this kind of risk for a non-negotiable goal. So if you're sending your kid to college, you don't want to put your money in equity if they're going to go to study in 2025, 2026, or 2027, because there's a good chance that you will end up with less than what you started with, right? This is where fixed income actually prepares you for better behavioral outcomes. The other thing being that when you see a negative return on one part of your portfolio, if the other part of the portfolio is performing well, you have a smoother journey. You also have a better chance at restructuring your portfolio if there's another liquid asset that's complementing your existing portfolio. So this is about rolling return data. And then there is one last thing of what does fixed income actually do for you? What are the benefits that you get from participating in a safer asset class? So the first is that you have more portfolio stability and you reduce risk and volatility in your portfolio. The second is that you have portfolio diversification. That means typically when equities move in one direction, fixed income moves at a slower pace or in a different direction. So, and then the vice versa is also true, where if equities are moving downwards, it's likely that your fixed income portfolio will hold its value or also increase in value over time. The third benefit that you have is if you're somebody who's looking for a regular source of income, then you have that from certain asset classes. So if you remember the table that we reviewed, if you're working with an FD or with a bond, you're likely to be able to structure a regular source of income. If you're working with debt mutual funds also, you can initiate something through a systematic withdrawal plan, which again gives you a predictable source of returns. Again, returns are very predictable in fixed income unless you're looking at completely open-ended instruments like AIFs and debt mutual funds, where you can have a certain expectation in terms of your yield to maturity and the target return. But that is influenced by so many factors that you need to keep a wide buffer and range to know that it can be lower than that or maybe even higher than that. Then we get to liquidity management, which is if you have short-term goals, if you have commitments that are coming up, if you want to prepare for emergencies, then fixed income is a great tool to help you deal with those things. And last, you want to hedge against deflation. So we've been in an inflationary environment. You can head into a deflationary environment. That's what happened to us in 2018-19. Inflation was very low and your interest rates were moving up. So it hedges against deflation as well. So quickly, just to cover a little bit about finesse as well as milestones to wealth. The M2W program is for any ambitious investor. Our goal is to take people from wherever they are to 1 crore in financial savings. And what is it that we do in this journey, right? While you save, we handhold you through this process. We guide you to the right investments. We organize webinars and conclaves where investors can actually learn from industry experts, can learn from people who are tracking the markets to understand not just on products and opportunities, but also behavior and risks. We also coach you because 1 crore can seem like a big target for a lot of people. We work with people who are able to save only a few thousand rupees every month, right? So in that process, to make sure that you don't lose motivation, that you don't get scared when the market behaves in a very unexpected way, and that you're able to do the right things at the right time in the right amount. So there's a lot of coaching and mentoring that happens in this process. And then, of course, we help you measure, right? The most important thing being that most people don't have a wealth creation target like 1 crore, especially when they're younger or with fewer financial resources. Nobody sets any ambitious targets for themselves. And there aren't that many people who are coaching you to do that as well. So that's where we come in. And we do all of this through mutual funds because that's been a great way for investors to really be able to create wealth on a sustainable basis. Then beyond this, what is it that the investor gets through this process, right? We've told you what we are doing. You're able to build financial discipline over a long period of time. You're able to cultivate something known as a growth mindset, which means that we are only setting 1 crore for you. But while you get to that 1 crore, you will probably be setting much bigger targets. And one thing that research also shows is that when you are very disciplined and use a lot of willpower in one area of your life, the positive effects of that actually spill over into other areas of your life. We help you build investment conviction, which basically means the best thing for an investor is to have an investment and stick with it for a long period of time. That only comes when you have that kind of belief and faith that you've made the right decision, because you need to stick through the ups and downs of what happens in the market. That is something where many people miss out on because at some point their faith wavers, especially when performance is not there. Whereas that's when you need to show the maximum amount of faith. We also provide investors with a very powerful tool, which is a wealth map, which will show them exactly what they need to do in every arena of their personal finance, whether it's about how much they can save on a month-on-month basis, or if it's about what kind of insurance policies they need, how much they need to set aside for emergencies. So all of this comes into your wealth map. And finally, when you have all of this put together, you're also able to scale, right? And scalability is what is going to get you from wherever you are to your first crore in savings. A little bit more about what we're doing at Finesse. Every month we publish a blog and a video with our monthly outlook. So we cover trends in the fixed income markets. We also organize webinars like this on a monthly basis. When investors choose to enroll in M2W, we help them with product selection, we help them with reviewing their portfolios and with constructing their portfolios over a long period of time. So with that, let me just open up for questions. I think we still have about 20 minutes. And I just wanted to leave our coordinates here for anybody who is interested in knowing more about finance or M2W. You can just reach out on this number 9677000613. Okay. So what I'm going to do now is, I think there are already a few questions in the chat box. So I'll begin by answering those questions. In the meantime, if anyone else in the audience has a question, please do type it in. We'd be happy to answer anything that's on your mind. So let me get to Mr. Murthy's question first. Ashwath Damodaran had recently commented that Fed rate is not controlling the interest rate offered in the market. Is it so? Whether we have similar relation in India also? So when we talked about growth, I said it was important to look at both liquidity as well as the interest rate, right? So when there's a lot of liquidity in the market, then your benchmark rates like your Fed funds rate or the repo rate in India is not really going to have such a great bearing on the cost of borrowing. So the cost of borrowing will be lower if there's more liquidity in the economy, even if the interest rate is optically at a higher level, right? Similarly, if your interest rate is at a lower level, but there's no liquidity, it's basically a supply-demand dynamic, right? You need to look at both things together. You cannot look at only one thing. So the US markets, the big issue there is that we've had the government kind of borrow, and their debt is actually ballooned, right? So their government debt is more than 100% of their GDP. So how are you going to repay debt when it's actually crossing the economic activity levels itself? So that is basically why it doesn't happen there. In India, our fiscal deficit is really not that high. And we have been consolidating. So we're moving into a path where we're borrowing less. And we're also in a stage where growth is much higher. So with the US, the risk is that growth is coming down and borrowings are very high, right? So if you think about that in a very simple manner, let's say I'm towards the end of my career, I'm in my 50s or my 60s, and I take a home loan, right, for 20 years. Now, when I take that home loan, how am I going to repay it? Either I should have the assets or there should be growth. But if I'm in the last stages of my career, I don't really have that growth that's pushing me forward, right? So that is where there is a higher level of risk. Okay. The next question, since gold ETFs are treated as debt instruments, and if we want 20% in debt, how much can we allocate to gold ETF? No. So now I think with the new budget, if I'm not wrong, gold, anything that's traded on the exchange, right? So that is your gold ETF, your silver ETF, all of those have the same taxation, which is 20% taxation for short-term gains, that is less than 1 year, and 12.5% long-term capital gains, that is more than 1 year. So you can allocate to precious metals. You can also allocate to fixed income. Now, the reason why I'm not going to be able to discuss this as what is the right allocation for you is that many factors go into deciding what is the right level of allocation that an investor needs to have. So one, like I'll just give you an example of the kind of factors that go into that decision. So your risk tolerance, your age, your financial goals, all of these are sort of going to influence how much exposure you need to have in both fixed income and gold, right? It's not just that, okay, today we are in a market cycle where gold is a good investment, so let me put in X% into that asset class. That's why I talked about strategic investing. You need to have a one-on-one conversation. Okay, next question. Considering current market, should we change our NPS allocation more towards corporate bond and government bond? Yes, you can have allocation towards fixed income. You need to see what are the equity assets that you are exposed to in the NPS. Because if you look at valuations, then your large cap valuations are more attractive than your small and mid caps. Also, if it's NPS, what is your investment horizon, right? Depending on your age. That means you can't recover from any loss because it's locked in and you don't really have to sell, buy, sell, buy. So it's really up to you. When the interest rate is going to reduce, is it advisable to invest in corporate bonds? Yes, because okay, so one thing is interest rates affect government securities more than they do affect corporate and I mean corporate securities to a certain extent, but credit is kind of independent of the interest rate cycle itself because credit is more about the individual borrower's balance sheet, their financial health, their ability to repay, their track record. So all of those things actually influence the credit markets more than the interest rate. Maybe there can be some trickle on effect based on liquidity, but it's not really like an interest rate. I mean, it's not really a repo rate or like, what the RBI does. Uh, I hope that answers your question. You can do bonds, you can do this thing. The other way that you need to look at this is if today you're going to allocate additional money into equity, what is your forward return expectation, right? We've had a fairly weak market in the last 5 trading days, the last 1 week, basically. And you're seeing tensions really mount across the world. So that risk of sentiment is actually entering markets. So then your forward return expectations from equities also has to come down a little bit. So between the two, you need to evaluate, okay, where should I put my money today? And does it make sense for me to put it in something that's earning a lower return for, say, a few months and then but gives me that stability and predictability and liquidity to move into something else later on in the future. So it's also an opportunity cost. So we need to look at it from both perspectives. When is the RBI expected to reduce interest rates? If I knew that, then I guess I would be in the RBI. We really don't know, but there is an exciting policy that's coming up this week. We're all looking forward to seeing what the RBI has to say and then trying to understand where to go from there. Okay, so if inflation is high, the RBI increases the interest rate and people will pay more interest. And then what happens? How does the cycle work? So basically, when you have high inflation and high interest rates, what you're trying to do is you're trying to reduce the liquidity in the economy. And when you do that, that tends to bring inflation down. But that is only assuming that inflation is coming from excess liquidity. What if inflation is coming from supply side issues? Right? Which is what happened post-COVID because there was no supply of certain goods and services. And that's why you had high demand because there was a lot of competition for certain things. Now, when it's a supply-related issue, you cannot intervene with interest rates if you want the inflation to come down. You have to intervene with supply. So whether it's possible to do that, whether it's not possible to do that, those are all things that we have to really think through. But this thing, so there is a term called stagflation, which is when you have high inflation and high unemployment, which is a very bad combination, right? Because it's not easy to balance both of those things because the tools that you would use are actually going to pull the economy in opposite directions. So minimum amount in bonds, it used to be about 10 lakhs, but the RBI and SEBI actually has been trying to reduce the face value so that investors can participate. So now I think typically if you have anywhere between 3 to 5 lakhs, there should be some bonds that are available for you to invest in. You have to go through a dealer or a broker, and typically they have like a minimum lot size. So they'll say minimum 5 lakhs or minimum 10 lakhs. So I think 5 to 10 lakhs, you should be able to get at least some bonds. And yes, in terms of what M2W does, we will help you select bonds that are suitable based on your requirements and your risk profile. Most of the online platforms are just marketplaces, right? Which means you have to do the due diligence and you have to go and select whatever bond you want to buy. There's nobody to guide you. And usually, what is displayed is the bonds with the highest interest or the highest payout, which may not be the best selection criteria. Okay, Gopi, are there any questions from YouTube? No questions from me. Okay. Anyone else with questions, please feel free to type it in the chat box. We still have about 10 minutes in our meeting, so I'm happy to engage with all of you. Also, before we close, I'd just like to say thank you since I see people dropping off. Thank you for spending time with us on Saturday. Theoretically, yes, but then this works both ways, right? If interest rates are high, then deposit rates are also high, which means the cost of funds is higher. It also means that it's less likely that somebody will want to borrow at higher interest rates. So the amount of loans that are coming in also will sort of reduce because corporates may not want to finance at high interest rates. If it's a listed bond, I think with the ISIN, you can check on any of the trading platforms. You should be able to see the price. But typically, what happens is bonds don't trade on a daily basis. So there can be 1-2 months before you see that particular bond trading, right? Otherwise, I think like if you had a Bloomberg terminal or something like that, you can view it. But I think most of us would not actually have access to those kind of platforms. Yes, deposit growth is going down at banks. That is something that the whole industry is trying to address, right? Whether it's the banks, whether it's RBI, even equity investors are keeping a keen eye on deposit growth. You're also seeing banks restructure a lot of loans, sell off part of their loan books, recapitalize through other means. So there are many ways to address this. It doesn't mean that it only has to come through deposits. But definitely banks need to be more competitive in terms of investment returns. You're welcome. What is the bond default risk? Any bonds failed to return recently? Default risk is basically their inability to pay. So that can come because the underlying quality of assets in their balance sheet is not good, or they're not able to collect. So if it's a, let's say, a microfinance institution, what is their capacity to collect funds for the loans, or collect interest and principal on the loans that they've issued? So all of those things are important checks that you do. Yeah, there have been. I mean, like if we look at the NBFC crisis, you had ILNFS default, you had DHFL default. These were all AAA rated companies that basically couldn't service their obligations. Then typically some of that got restructured. Somebody bought out those loans, then they got serviced. In other cases, the company needed more time to pay investors back because collection was delayed. So yeah, default risk is that one, you may permanently lose that capital. So if you look at Yes Bank perpetual bonds, those were permanent defaults. So those investors did not get their capital back. Whereas if you look at, let's say, the Franklin Templeton issue that happened during COVID, those investors have pretty much got their money back. It was just a matter of time. So there can be both like a duration, I mean, like a lag in which you expect your money versus when you receive it, or you may not receive that money at all. Both things can happen when there's a default. I'm always happy to answer questions. Please feel free to send across anything that's on your mind. So we still have a couple of minutes. I'll take two more questions and then we can close. I'd like to wish everyone happy weekend. So please enjoy yourselves. We have more webinars happening today and you can possibly catch those as well. Okay, when to add more on debt funds during the rate hike or to accumulate when the rate falls down to catch up? Debt fund outflow was higher when compared month on month. Any viewpoint on this? Yeah, actually, this is a very interesting question. So let's get into it. I'll answer both questions separately. So when do you add more on debt funds? You have to add on opportunities, right? So the opportunity changes depending on which part of the cycle that you're in. So if you're at low interest rates and you're moving up, funds like floaters, short term, that could do really well. There are some fund categories which do well throughout, right? So if you have, so the returns will be relative to where you are in the interest rate cycle. So if you, for example, if you bought a corporate bond fund in COVID, when interest rates were really low, your returns will be 4 to 5%. That doesn't mean you made a bad decision. That is just reflective of what the returns were at that point in time, right? If you that same investment, if you had made in 2018 when the NBFC crisis was happening, you would have probably made 9-10% on a 3-year basis. So it's really a matter of when you invest, you'll always have returns that are linked to whatever the cost of borrowing and your interest rates were at that point in time. So you need to look at it as a relative, not whether you're making a good return or not. Right? So if you made like 5% in 2018, like between 2018 and 2021, that's a bad return. But if you made 5% between 2021 and 2024, that's a good return, right? So we need to look at it from a contextual perspective and not from a absolute return metric. So your opportunities will change. So when you're hiking interest rates, you want more floating rate or variable returns or short-term instruments so that you can so that you get into higher interest rates as you move up. When you're at the top of the interest rate cycle, so see, when you're at when you're at the top, it's like everybody knows that you're at the top, right? It's not like an unknown. So when there's no unknown source of return, everyone's on the same page. The expectations are pretty much set. So there's no point in taking duration right at the top. You have to start as you get to the top of the cycle, because like I said, there's been a long time when we've had an interest rate pause, which means for a while you've had this duration opportunity. So that trade is now very crowded in. So you have to look at something else. You have to look at liquidity management. You have to look at protecting that return. So if you want to capture certain MTM, you can still take a longer duration call. Second question, debt fund outflows have been higher. If you look at that, that's basically because a lot of industry level changes have occurred, right? In the sense that one, you first in last year, they took out indexation benefit for new investments. By basically saying there is no such thing as long term or short term. Then this year in the budget, they took out the indexation benefit for all investments. So there's no such thing as indexation. This has really changed how people view fixed income and debt funds as a opportunity or an asset class. Because previously, if you looked at it, if you were a debt fund investor with indexation, your returns post tax on a 3 to 5 year basis would have been close to 7%. So now investors are still chasing that same post tax 7% return, which is why they're moving into the bond market. So those are my thoughts. It's basically like a tax change, which has resulted in a behavior change and a preference for more riskier assets in fixed income. Okay, this is the last question I'll take. We've overshot. So when do we need to pay towards loans? When interest rates are high or low? Always a dilemma. So you can ideally pay more when interest rates are lower, because then you're basically closing more of your principal down, right? But you need to weigh that against your opportunity cost. So if interest rates are low and market is giving you better returns, then you need to see what is your cost of borrowing, whether the market returns are going to make more sense, or if the closing down the loan makes sense. Now, actually, that's something that needs to be managed on a dynamic basis. So you need to have a set plan where you're paying your EMIs, and then you need to have a variable plan where you have to choose between investments and loan closure. So that again is something that if you're with M2W, you can do that as part of the wealth map as well. All right. Thanks again once to everybody who's here. It's been a great session, and I think a lot of things were discussed today. We hope this added some value to your journey, and we'll see you soon in our next webinar.